So in this video, we will look at the second component of our aggregate demand, that is investment. So investment is defined as the expenditure on production of new plant, equipment, and structure capital in a given time period, plus change in the business inventories. So it's very confusing sometimes, especially if you are a finance major. So you heard the term investment multiple times. And one thing I want to emphasize is here we are learning economics. So when we talk about investment, it is focusing on the physical investment instead of invisible investment. So what do I mean by invisible investment? Such as investment on the stock market. So your investment will not help the production. So we are not considered as investment based on the definition of this class. So the investment has to be something you're gonna help in the production, like I mentioned here, the new plant, equipment, structure. So the reason is when we talk about this kind of investment, so they are purely helping the economy and not only to try to make somebody rich, but actually will generate the momentum. Because you think about if we have a new plant developed, new equipment purchased, and develop a new working structure, and what happens is it actually will help to increase the employment rate. If you just earn a lot of money on the stock market, it doesn't mean it will help to create more jobs. So that's why the investment here is talking about the physical investment. It is not the investment on the financial market. So keep in mind. So similar as our consumption, the next we will look at is what actually gonna affect our investment. So what actually gonna affect our investment in the business world. So when we talk about investment, it has fixed investment and inventory investment. So fixed investment including the new investing on the new plant equipment. Then when we talk the inventory investment, such as you purchasing more stock and store it, increasing your inventory, or you sell more and you lose your inventory. So that will also consider as part of the investment activity. So what will affect the investment? And so the first factor will affect investment is called expectation. So very similar as the expectation when we talk about consumption, but here we focus on the business. So the business expectations regarding future sales play a crucial role in the investment decision. So higher expectation of the future sales are a necessary condition for investment. So that's why once we see the lower interest rates on the market and we saw more and many factories start to extending their investment because they are looking for the future that they feel that they have a very likely they will sell more product because we have more people finding job. That means their disposable income increase. They can afford buying more product for the business guy, and they sense that they will start to think, wait a second, I should start to make more because people can afford more. So they are have very high expectation once they see the consumer have a very strong economic background. So this will be the first factor. And then the second factor is interest rate. So businesses often borrow money to invest in a new plant or equipment. So the higher the interest rate, the costlier it is to invest, and thus the lower the investment spending. So more investment occur at the lower interest rates. So now you understand why the Federal Reserve Bank can use the interest rate to control the investment, because the interest rate actually highly affect the business decision makers to decide if they want to invest more or invest less. And so one thing you have to keep in mind that the interest rate the Federal Reserve Bank rise is not all interest rate. So unfortunately for other interest rate, like the interest rate for borrowing and lending, they are all watching the Federal Reserve Bank decide the interest rate. So if that's the baseline. So if your baseline increase, and then you'd better increase your interest rate value as well. So this is how the interest rate affect the investment. So the last determinant will affect our investment is the technology and innovation. So the new technology often increase investment. For instance, when electronic circuits were miniaturized, investment increased due to the creation of the pocket calculator industry. So it's very interesting, right? So when the technology advance, actually will help to improve the investment environment, So after we understand the determinants, so three determinants affect the investment. So next we will look at how the investment curve shift and how that affect our aggregate demand curve. So on this chart, we are seeing our investment function, and you can see our vertical axis. It is not our consumption anymore because we're focusing on our investment. So the vertical axis actually is our interest rate, and the horizontal axis actually is our investment and spending. So we see this is kind of inverse relationship, which means the higher interest rate and the less investment. The higher interest is the less investment, or the lower interest rate, the higher investment. Why? And the one thing I want you to keep in mind is that the interest rate is considered as the you have to pay for your opportunity cost. You have to pay for your opportunity cost. So you can see the higher interest rate, and people will find it's more valuable to put money in the bank than do an investment. So that's why they will invest less. But when the interest rate is super low and people realize that putting money in the bank is not valuable, considering the inflation, they might even losing money. So that's why you have this kind of inverse relationship. So what we can see here is when the investment spending is inverse relative to interest rate. Second, if expectation of the future sale improve, and what we will see is the investment function will shift to the right. So shift to the right means we have more investment, and we understand that the GDP increase is coming from the investment increase. So if what we see here, our investment increases, and it's no surprise that our aggregate demand should increase. That's why we shift to the right, and vice versa. Oops. And so the investment spending is the most volatile category of the spending. So remembering, consumption is the largest part of the spending, but investment is the most volatile category of the spending, which means for the investment, actually it's up and down all the time, It doesn't like the consumption function. So in our next video, we will look at our government and the net export spending.